Hi, today I'm going to be explaining more about the topic of financial institutions. And after this video, you should be able to answer the following questions. First of all, what are financial institutions? Secondly, what kind of financial institutions are there? What are their roles exactly? What exactly does a financial institution do? And what is their impact on the financial markets? And personally, I've chosen to explain more about this topic because I think if you want to understand money and also be successful in trading and investing, you need to know and understand what these financial institutions are and what they actually do. Roughly 70 to 90% of daily trading volume occurs through financial institutions. So as an individual investor, you barely have any influence. On the other hand, as well, most retail traders lose money, and quite a lot of financial institutions make billions a year. So I think it's really important that you understand what these institutions do differently from normal investors like you and me, and that can give you an edge over all the others. And it's yeah, just a great opportunity to learn from the greats. But before we start, I think it's important to explain what a financial institution exactly is. And according to the definition, it's a company that is involved in financial and monetary transactions. Think about providing investments, deposit, loans, insurance, and brokerage. So it's basically a company that deals with money. Of course, there are many companies that deal with money, but I'm going to be talking about the big ones you will see on Wall Street. Think about investment banks, hedge funds, and asset managers. So let's dive into the very first one. Banks, more specifically investment banks. And yeah, these are large ones. Think about your Morgan Stanleys, your Credit Suisse, Goldman Sachs, JP Morgan. You should know these names. And they provide a variety of services that are quite different from those of commercial banks. For example, they assist companies in mergers and acquisitions, initial public offerings. So the first time a stock or a company goes public, a lot of them have trading desks as well, where they trade stocks, bonds, and other financial products. And some also engage in market making activities. That's a kind of brokerage activity, and asset management. Could be for an investment fund, could be for ultra high net worth individuals, people with more than 30 million in net worth. And these have a massive impact, these investment banks, because they enable companies and governments to raise funds by issuing shares and issuing bonds. So without these investment banks, it would be much, much harder for companies and also for governments to fund their operation, and the economy would probably not perform as well as it currently does. And also by enabling companies to raise money, the investment banks help the growth of those companies, and with that, the growth of the economy and the financial markets. And as I said before as well, some also engage in market making activities, which basically means that they provide execution and liquidity for traders. So if they didn't exist, trading in the markets would also be a lot less efficient and much harder. Well, the next financial institution I want to talk about are hedge funds. And hedge funds are privately managed, actively managed investment funds that pool money together from what they call accredited investors. And they try to generate significant returns by using, first of all, complex strategies, but also by taking a lot of risk, for example, with leverage. And usually, if you want to invest in a hedge fund, you need to meet certain wealth requirements and make a minimum investment. And there are a few different types of hedge funds. For example, you have your global macro funds. They try to profit from market swings that are caused by political or macroeconomical events. Think about trading on interest rates, oil price, gold price, currencies like that. You have equity funds. They invest in, well, the equity of companies, so in stocks, and then they hedge them. You have relative value funds. They try to profit from the temporary discrepancy in price between assets through high frequency trading. And then you have activist hedge funds, and those buy pretty significant stakes in companies to gain control and influence over the company and the management. And these hedge funds are incredibly powerful because they manage the money for the world's richest and most powerful people, governments, and institutions, about 5 trillion in total in assets under management. And they constantly try to implement new technologies to outperform their competition. So think about implementing AI and machine learning into their high frequency trading strategies. So it's very relevant nowadays, you can say. And then the last financial institution I want to talk about today for wrapping up are asset managers. And these are your financial institutions that invest money on behalf of their clients. Could be individuals, could be companies, pension funds, governments as well. And their main goal is to have very steady growth and protect the investments and then balance the risk and reward ratio according to the client's objectives and the client's wishes. And their main activity is creating investment portfolios across different asset classes. Think about stocks, bonds, real estate, and then selling those. Think about selling an S&P 500 ETF, for example. One of the best examples is BlackRock. They manage more than 10 trillion in assets under management, which makes them the largest asset manager in the world. But Vanguard, Fidelity, and State Street are also really, really big ones. And they have a lot of influence because of the sheer size of the funds they manage. And the impact that they have on the financial markets is huge. First of all, they are the driving force behind the growth of passive investing in ETFs, for example. And because they do this, they also have very large holdings that they usually hold on to for quite a while, regardless of what the market really does. So that also ensures stability and liquidity in the market. And on the other hand, they have really, really large stakes in companies, which gives them massive voting power and influence in those companies and their strategy and their governance. So it's also an ethical question of how much power can we really give these companies because they are probably more powerful than most countries, you could say. So, in conclusion, in short, hedge funds really try to beat the market with aggressive strategies, and asset managers are much more focused on long-term growth. And then the investment banks help the companies that are owned by the hedge funds and the asset managers to grow, and the hedge funds and asset managers are helped as well by the investment banks in executing trades. So it's all interconnected, which makes the financial markets very. Thank you for watching.